Have you ever looked at a stock chart and just thought, this makes absolutely no sense? Well, you've spotted what we call a behavioral inefficiency. It's that gap between what a company is actually worth and its stock price, a gap that's driven entirely by human psychology. In this explainer, we're going to break down why these gaps happen and, more importantly, how you can think about them. Because the biggest challenge here, we're all human too.
You know, the father of value investing, Ben Graham, just completely nailed it with this quote. Technologies, companies, economies, they all change, but the way we humans react to fear and greed, that is a constant. And because human nature is really the engine of the market, those psychological patterns, the booms and busts, the manias and panics, they are absolutely here to stay.
So to really get a handle on this whole idea, let's try a classic thought experiment. Just imagine the entire market, all of its noise, all of its ups and downs, was a single person, and that person was your business partner. What kind of partner do you think they'd be?
Well, Ben Graham actually gave that partner a name, Mr. Market. And truly understanding this character is the key to seeing how a stock's price can become completely unglued from its actual value.
Okay, so here's how the story goes. You're a part owner in a private business, and your partner is the very helpful Mr. Market. Every single day, without fail, he shows up and quotes you a price. He's always willing to either buy your shares from you or sell you his shares at that price.
But here's the catch. Mr. Market has, as Graham so brilliantly put it, incurable emotional problems. Some days, he's just completely euphoric, offering you a ridiculously high price because he's convinced the business can do no wrong. But on other days, he is deeply depressed, and he'll offer to sell you his shares for pennies on the dollar because all he can see is doom and gloom ahead.
And this, right here, perfectly illustrates the most crucial point. Mr. Market is your servant, not your master. You should feel totally free to just ignore him on most days. But when his manic-depressive swings offer you an obvious bargain, either to buy from him when he's panicking or sell to him when he's euphoric, that's when you act. You get to use his irrationality to your advantage.
And look, this isn't just some cute story. The data backs it up. This slide shows some of the biggest single-day moves in the S&P 500. Now, while some are tied to big news, a lot of them just seem to defy easy explanation. Just look at number 3 on the list. October 28, 2008. We're in the absolute depths of the financial crisis, and the market rips 10.8% higher on a headline that reads, "Rebound in stocks defies latest economic news." That's Mr. Market in real life, a huge move driven by emotion, not by the facts on the ground.
So if the market is just a big collection of individuals who act like Mr. Market, how can it be rational one minute and then completely mad the next? Well, this brings us to this paradox of the crowd, and how it can be both incredibly wise and totally insane.
The core idea here is really fascinating. A market can be efficient even if the individuals in it are not. You see, an overconfident buyer might get canceled out by an overly pessimistic seller, and what you're left with is a surprisingly rational price. As long as investors have different views and are acting independently, these individual errors cancel each other out, and the collective result is, well, it's often surprisingly wise.
Now, this system works beautifully until a key condition breaks down: diversity of thought. A wise crowd, you see, is made up of investors with all sorts of different beliefs and strategies. But when those beliefs become correlated, when everyone starts thinking and acting the same way, the crowd goes mad. The price no longer reflects a balanced consensus of different views. It just reflects one single dominant emotion, like fear or greed.
Okay, so what causes this breakdown in diversity? What are the psychological engines that can hijack the entire crowd and send it careening into madness? Well, there are a few key biases that we really need to understand.
First up is a big one, overextrapolation. This is our powerful and very natural tendency to take what just happened and assume it's just going to keep happening forever. When a stock is going up, our brain tells us it's going to keep going up. This is the simple logic that fuels what we call performance chasing.
But here's the paradox, and it's a huge one. Empirically, the exact opposite is often true. You see, periods of high returns lead to high valuations, and as this slide shows, high starting valuations are consistently linked with lower returns over the next several years. So the very thing that makes investors most bullish, a history of amazing returns, is often the very thing that should be making them the most cautious.
And this leads us directly to the concept of sentiment, which is basically just the overall mood of the market. When overextrapolation runs wild, sentiment can become extremely bullish or bearish, pushing prices way beyond what the underlying business fundamentals could ever support. And extreme sentiment, especially for the more speculative stocks out there, is often a really powerful contrarian signal.
A perfect real-world example of this is the so-called magazine cover curse. You've probably heard of this. When a CEO or a hot stock finally makes the cover of a major business magazine, it's usually after a period of just incredible performance. That glowing positive story often marks the absolute peak of sentiment, right before performance reverts back to average, or sometimes much worse. The crowd's enthusiasm is at its maximum right at the top.
So when you take these forces of overextrapolation and sentiment and you turn them up to 11, you get the ultimate expression of a mad crowd, a speculative bubble. This is where price completely detaches from any reasonable estimate of value, and a whole new story, a new narrative takes hold to justify the insanity.
You know, bubbles tend to follow a pretty predictable 5-act play. It starts with a displacement, some genuinely exciting new technology or a new government policy. Then comes the boom, as the smart money sees the potential and prices start to rise. This rising price then attracts the public, kicking off the mania phase, where belief is suspended. But eventually, you just run out of new buyers, and the market enters distress. That's when the story breaks and the final act begins. Panic, as everyone rushes for the exit at the exact same time.
Okay, this is the critical question, right? With hindsight, every bubble looks so obvious. But in the moment, is every massive run-up in price a bubble that's just doomed to crash? Let's see what the data actually says.
A landmark study called Bubbles for Fama looked at every single major industry price run-up in the U.S. market since 1926. And what they found was that just over half of these big run-ups were followed by a crash, which they defined as a 40% decline or more.
So the crucial point here is this. While a massive price increase doesn't make a crash inevitable, it dramatically, and I mean dramatically, raises the odds. The risk profile of that asset has fundamentally changed. The average return after one of these big run-ups might look okay, but that average hides a very dangerous new reality. You're now looking at a roughly 50-50 chance of a catastrophic decline.
Okay, so we've explored Mr. Market's moods, we've talked about the psychology of the crowd. How can we translate all of this into a practical toolkit? How do we stay sane when the market goes mad?
First, you have to guard against your own tendency to overextrapolate. Catch yourself when you start projecting today's amazing trend into forever. Second, keep an eye on sentiment. When literally everyone agrees, either that something is a sure thing or that it's doomed, that is your signal to be skeptical. And maybe most importantly, learn to reverse engineer the price. Ask yourself, what incredible future do I have to believe in to justify this price today? And is that belief even remotely realistic?
And when you see what looks like a bubble forming, try to place it on that 5-stage timeline. Are we in the early excitement phase or late-stage mania? Always remember that smart markets need different opinions. A total consensus is a huge warning sign. And finally, anchor yourself to testable facts, things like revenue, earnings, cash flow. You've got to avoid getting swept up in the grand, unprovable stories about the future that fuel every single bubble.
And let's end right back where we started, with the incredible wisdom of Ben Graham. The ultimate defense against all of this is just independent thought. It's not about being a contrarian for the sake of it. It's about doing the work, trusting your own analysis, and having the courage of your convictions. You aren't right or wrong because the crowd agrees or disagrees with you. You are right because your facts and your reasoning are sound.